Hello everyone, welcome to this video on AS A-Level Past Paper Analysis series, and in this video we are going to analyze May-June 2022 paper, and under that we are going to analyze 21, 22 and 23, paper number 21, 22 and 23. So before watching this video, I would like you to first finish all your chapters in the syllabus, attempt the past paper properly, and then you can come watch this video, see how I have analyzed the question, what I have thought while reading the question, and then try to improve. So to study for AS A-Level syllabus, you can watch the videos in the AS A-Level accounting series playlist on YouTube, or you can also consider purchasing the online course on AS A-Level accounting. So let's begin this video. The first question: Kin is a retailer. The following balances have been extracted from his books of accounts. So some accounts are given: advertising, carriage inwards, outwards, furniture equipment at cost, and depreciation, accumulated depreciation is given. General expenses, okay, opening inventory is given, irrecoverable debts are given, loss on disposal of delivery vehicle, okay, premises at cost and accumulated depreciation on that. Then provision for doubtful debts, opening balance is given, purchases, rent, receivable, so this is an income, and revenue, trade receivables, and wages and salaries. So let's read the other information. So, okay, before reading the other information, let's see what is the question in part A, part B, so that while reading the additional information, we can analyze accordingly. So if I go to the next page, they've asked me to prepare the income statement. So all the additional information that we will read with that perspective. So closing inventory, we know that it'll go in the trading account in the calculation of gross profit. Then no record has been made of goods taken for own use by the owner, 910. So this will be deducted from the purchases value in the trading account. Irrecoverable debt of 380. If you see the trial balance, there is an irrecoverable debt of 670 already. So when you write the irrecoverable debt as an expense in the income statement, so make sure you take 670 plus 380, total 1050 in the income statement. So there's an adjustment in irrecoverable debts. Provision for doubtful debts is to be maintained at 5% of trade receivables. Now in the trial balance, the trade receivables is at 15,580. But out of this, there is an additional irrecoverable debt given 380 in adjustment number 3. So to calculate the net trade receivables, first you will have to subtract 380. So you get 15,200. On this, we will be applying a rate of 5% to arrive at the closing doubtful debts balance. 5% of 1520. So that is 760. If you see the opening opening provision for doubtful debts, it is 840. And at the end, we just need 760. So there is a difference of 80, and the closing provision for doubtful debts is lower than the opening. So there will be an other income in the income statement of the difference, which is $80. Advertisement includes payment of 3250 for a campaign which will last from 1st December to 30th April. Basically, this is a period of 5 months, total period of 5 months. And for these 5 months, a payment of 3250 has been already made, and it is included in this advertising expense 4,900. Year ends on 31st Jan. So out of these 5 months, 2 months are falling in the current financial year, which is December and Jan, and the remaining 3 months are falling in the next financial year. So these 3 months, payment made for these 3 months will be treated as prepaid advertising expense. So 3250 divided by 5 multiplied by 3, 1950. This 1950 will be prepaid advertising, and it will be deducted from 4,900 in the income statement under the expense section. So 4,900 minus 1950, you will take it as the difference. So the advertising, there is an adjustment. Whenever I see an adjustment anywhere, I always try to put a mark so that when doing the income statement, we don't miss out on the adjustment. Rent receivable is 500 per month, and in a year there are 12 months. So 500 into 12, our annual rent that should have been received should be 6,000, but here in the trial balance it shows as 7,000. So obviously extra paid is the prepaid rent 1,000. This will be deducted from rent receivable. Basically in the income statement you will just show 6,000. Wages 1,440 are outstanding. So when we go to wages 34640, to this we will add 1,440 when doing the expense section, and we write wages, we'll add it and take the total. Kin sold his business's only delivery vehicle in Jan, resulting in a loss of 1,350, shown in the balances at 31st Jan. The loss on disposal of vehicle, it is already shown here 1,350, it's already here. Basically all the entries of disposal are already complete. Even if they had not given this information, it would not make a major difference. You will treat this as an expense in the income statement. The business's depreciation policy is that premises to be depreciated at straight line method 2% per annum. So premises at cost is 360,000. So 360,000 into 2%, 7,200 will be depreciation of premises, and furniture and equipment to be depreciated at 15% using reducing balance. So the furniture and equipment cost is 18,900. Accumulated depreciation is 7,300. This multiplied by 15%. Basically 11,600 into 15%, that will be the depreciation for furniture and equipment. So I'm not going to solve the entire income statement, but when doing the trading account, you will start with revenues 197,300. Then you will calculate the cost of sales below that, which is opening inventory 12,310 plus the purchases value 118,220. From that you will deduct the stock drawings, which is adjustment number 2, and below that you will deduct the closing inventory, which is adjustment number 1. You will arrive at the cost of sales, then you will arrive at the gross profit. After the gross profit, you will have to add other income. Under the other income section, there are two items here. One is the rent, which is 6,000 we calculated, and then the provision for doubtful debts, because it is decreasing. The closing balance was lower than the opening balance, so $80 was income for the year. Then you will deduct all the expenses. Okay, in the trading account, I missed out on carriage inward. This will also be added to purchases to arrive at the cost of sales. All other expenses like carriage outward, advertising, general expenses, irrecoverable debts, loss on disposal, and then we have wages and salaries, and then two items of depreciation. All this will be recorded under expenses. You take the total of expenses and then you get your net profit. The second section, or the part B, wants us to prepare the rent receivable account. Let's see what information do we have for rent receivable. Basically in the trial balance it says 7,000, which means that during the year the sole trader Kin has received a total rent of 7,000 in cash or by check. Basically money is received 7,000, and we have closing prepaid of 1,000 because the annual rent is 6,000. Also another thing to notice that there was no opening balance. So we don't have opening balance. We can directly start with recording the receipt of rent, which is 7,000. We know that the annual rent is 6,000, so that will be transferred to income statement 6,000, and the prepaid part will be 1,000. So that completes the rent receivable account. Don't forget to bring down the balance also. Part C, prepare a journal entry to record the adjustment to provision for doubtful debts. If you remember, our provision for doubtful debts balance, closing balance, has to be reduced compared to the opening balance by $80. So in the journal entry, we will have to debit the provision for doubtful debts account. When the provision for doubtful debts has to be increased compared to opening, we credit the provision account. And in this case, the credit will go to income statement. And as it says, narrative is not required. Kin intends to purchase a new delivery vehicle. He is not sure whether the delivery vehicle should be depreciated using straight line method or reducing balance method of depreciation. Explain the reason for recording depreciation in a business's income statement. Since it's 2 marks, what I will do is I will take up one reason and I'll explain it properly. So you could explain the matching concept. It is because of the requirement of matching concept that depreciation has to be recorded systematically over the useful life of the asset so that the expense of depreciation can be properly matched with the income or revenues that are generated because of using that asset. So the incomes and expenses should be properly matched as per the matching concept. State one benefit of using each of the following methods of depreciation. So for straight line method, we can say that it is easy to calculate and understand. Basically, no technicalities involved. The cost of the asset is distributed evenly over the life of the asset. Very easy to calculate. For reducing balance, advantage is that the depreciation is more realistic. It is more systematic, especially for assets like vehicle, where the benefit from the asset is much higher in the initial years because the asset is very efficient in the first few years. Later on, a lot of repairs are there, other expenses have to be incurred on the vehicle, so it is better that depreciation in the later years is lower and in the initial years it is higher, which is possible in reducing balance method. So here we can say that the depreciation is charged in a more realistic manner for assets generating higher benefit in the initial years. Then additional information given. Kin is concerned about a decline in business's profitability. He is considering two options. Option 1, decrease the amount spent on advertising while also reducing the selling price by a small amount. So you reduce the advertising cost and you reduce the selling price with the anticipation that quantity sold will be more. Overall, they want to increase the profit by doing these two things. Or second, purchase goods from cheaper suppliers. Basically, whatever purchases they're doing, maybe currently they're paying a high price for their goods. They intend to purchase it from suppliers that are offering cheaper prices. Advise which option he should choose. Justify advice by discussing both. So you will have to write points for both option 1 and option 2. Let's say around 3 marks for writing option 1, the advantages or disadvantages under option 1, 3 marks for writing the advantages and disadvantages for option 2, and then 1 mark for we can call it advice. Finally, what would you advise? 1 mark for that. So if you choose option 1, firstly, if you decrease the amount spent on advertising, profits will increase. The effect of obviously decreasing the advertising expenses to increase profits. But the bad impact or the disadvantage of reducing advertising is that the demand for the product may fall and we may lose our customers to the competitors. So you can explain that. And then reducing the selling price by a small amount. When selling price is reduced, it may encourage more customers to buy the product, or customers may buy the product in higher quantities. But then the business will lose if this reduction in selling price does not encourage them to that extent, or it does not increase the demand to a great extent. Ultimately, the business will lose. So you can explain these points. And then for option 2, if goods are purchased from a cheaper supplier, it will directly lead to increase in profits because of lower cost. But there are problems here. If the products are not of superior quality or they are poor quality, customers may not stay with the business for a very long time. The customers will be lost to competitors. Another problem is if you rely on cheaper suppliers or new suppliers, there may be problems with deliveries. Timely deliveries may not happen. So there also the business can lose customers. Ultimately, we have to give an advice which one, whether option 1 is better or option 2 is better. I think we can write that option 2 is better, but the business has to make sure that it has good control over the type of suppliers, over the quality of the products supplied, over the deliveries. Once all of this is controlled, profits can be increased in a better way with option 2. Then question number 2, Yasmin is a sole trader. She prepared a trial balance. Some errors not revealed by trial balance. Correct? There are two-sided errors and one-sided errors. Two-sided errors are not revealed by a trial balance. Describe each of the following errors. Examples are not required. Fine. Error of commission. Error of commission happens when an amount is recorded in the wrong account of the same class with the same amount and on the correct side. The thing is, it is in a wrong account of the same class. Error of original entry happens when a transaction is incorrectly recorded in the book of prime entry, and then the effect of that error is carried forward into the other accounts also. Error of principal happens when an amount is recorded in the wrong account of a wrong class or a different class. Then we call it an error of principal. Additional information: when Yasmin prepared a trial balance for a business at the year end, 31st December 2021, the totals did not agree. The difference was entered in a suspense account. The following errors were discovered, which accounted for the difference. Goods for own use 430 had been debited to the drawings, but no other entry had been made. Basically, the correct entry is drawings, debit, purchases, credit. But the second part, which is purchase credit, was not done. Because of this, there was a difference in the trial balance. Return inwards 740 had been credited to return outwards account. In the correct entry, basically return inwards have to be debited. But what did they do? They did not do this. In fact, they credited return outwards. So it's a double mistake. So when rectifying, we'll have to rectify the return outwards also by debiting it, and return inwards had to be originally debited only. We did not debit, so we'll have to debit that also in our rectification. So both will have to be debited. An irrecoverable debt of 260 had been correctly recorded in the journal and in the account of customer, but had been posted to the wrong side of irrecoverable debt account. So to do it correctly, irrecoverable debt has to be debited. It's an expense. But instead of debiting, they put it on the credit of irrecoverable debt account. So that's a mistake. So we'll have to correct this by debiting the irrecoverable debt account twice. Once for correcting the credit and another time for giving the debit effect. Okay, part B tells us to prepare the suspense account and then identify the original difference in the trial balance total. See, the original difference is not given. So when we put all these entries 1, 2 and 3 in the suspense account, whatever difference we get, that we will have to put as the original difference in trial balance. In such cases, when preparing the suspense account, I would suggest you to keep the first row blank, because we don't know on which side there would be the difference in trial balance. So we'll keep the entire row as blank. We will start from the second row. Okay, the first one, goods for own use 430 had been debited to drawings account. No other entry had been made. So we'll have to credit the purchase account and debit the suspense account. So in the suspense account, the entry will appear on the debit side 430. Okay, what I'll do, I'll write down the rectification entry also here. So suspense debit, purchase credit 430. Second, we have to debit return inward. We also have to debit return outward, and the credit goes to suspense with the total 740. So 1480. So credit side of suspense account, return inward 740 and return outward 740. Number 3, an irrecoverable debt of $260 had been correctly recorded in the journal and in the account of customer, but had been posted on the wrong side of irrecoverable debt account. So as I told you, irrecoverable debt has to be debited twice. So with the double amount 520 and suspense has to be credited 520. So credit side of suspense account, irrecoverable debt 520. Now if you see the credit side is greater, so what I'll do is I'll take a total here 1480 plus 520 2000 on the debit side also, right? And then the difference on top I will write difference in trial balance 1570, which is 2000 minus 430. Never use abbreviations like difference in TB, you will lose marks. Another mistake that students can make is that instead of writing this difference in trial balance, they would write balance brought down, which I think is not correct. Even though in the marking scheme you may see balance brought down, but I think it's not the right thing to do, because whenever there's a difference in trial balance, we always start suspense with difference in trial balance. So I would suggest to use these terms, difference in trial balance. Business's rough profit before correcting the error was 28,750. Complete the following table to calculate the corrected profit for the year ended 31st December 2021. Okay, in the first error, when we credit the purchases, our profit will increase by 430, because crediting purchases means decreasing purchases. Purchases decreases means cost of sales decreases and gross profit increases. So plus 430. Then in the second entry, we are increasing our return inwards. When you increase return inwards, what happens to net revenue? It falls and profit also falls. And the second effect is to decrease the return outwards. Purchase returns, when you decrease it, your net purchases increases, cost of sales increases, and profit again falls. So the overall fall in profit will be 1480. Since it is a fall in profit, you're putting it as a negative number. And in error number 3, we have to debit the irrecoverable debt account, and that too by 520. So that increases the cost by 520 and decreases the profit by 520. So minus 520. When we take a total, 27,180 is the corrected profit. Question number 3. Maria and Rio have been in partnership for a number of years. They are considering admitting a new partner. State three disadvantages to existing partners when a new partner is admitted. So admission of partner, the disadvantage would be share of profit. The profits of the business will be shared between the partners. So each individual partner's share reduces. Then since the number of owners in the business increase, we can say that the decision making will now be slower. So slow decision making. As the size of the organization increases, the decision making speed reduces. And then we can also say that there are higher chances of clashes between the partners. So we can say that higher chances of disagreements among the partners. I would want you to write this in a better way, not the way I have written it. You have to state it as a proper sentence. For example, share of profit, you can say that the overall profits of the business will now be shared between more people and individual share of profit reduces. This way you'll have to explain all the points. The partnership year end is 31st December. For the year ended 1st Jan to 30th September, Maria and Rio did not have an agreement. Okay, then year ends on 31st December. Okay, the balance on partners account where so and so on 1st Jan, capital balance is given, and Rio has given a loan to the firm. On 1st October, they admitted Sarah. She got capital of 45,000, no adjustment for goodwill and no revaluation. Okay, that makes the question easier. Rio has to be given interest on his loan at 8% per annum. That is from 1st October when they made the agreement. Before 1st October, there is no partnership agreement. So for the first 9 months, the provisions of the Partnership Act will apply. So side by side, what I'll do is, before admission of Sarah, what are the provisions? We will write that Rio is to be given a loan of loan interest at the rate of 8% per annum, but before admission of Sarah, this will be counted as 5% as per the partnership law. Then interest is to be given at 6% on capitals, but before admission of Sarah, we'll take this as 0. Rio is to be given a salary of 15,000. Before admission, we will take it as 0. Profits to be shared between the three partners, 2:1:2. Before admission of Sarah, we'll take it as 1:1. So we need to prepare the appropriation account. You will start with the profit, and the profit given is, okay, next page. During the year 31st December 2021, the partnership made a profit of 82,500 before taking into account interest on Ria's loan. It is assumed that profit before interest on Ria's loan had been accrued evenly throughout the year. Okay, so profit before interest 82,500. We will divide it in the ratio 9:3, 9 months before and 3 months after the admission. So 61,875 and 20,625. Then from this we will subtract interest on loan for Rio, and before the admission we will count it as 5%. So 6,000 into 5% into 9/12, and for the remaining 3 months 6,000 into 8% into 3/12, so 120 and 225. So that then we get the net profit for the year. What you can also do is you can start your appropriation account directly by net profit for the year and show this as a working note below the appropriation account. That approach is also okay. So 61,650 and 20,505. From this we will deduct interest on capital. I do not see any interest on drawings, so we'll ignore that. Interest on capital for Maria, Rio and Sarah only for the 3 months after admission, which is 52,000 for Maria, 50,000 into 6% into 3/12. Same way for Rio it is going to be 38,000 capital, and for Sarah it's going to be 45,000. Same calculation. No interest in the initial period in the first 9 months, and later on the interest calculated will be 780, 570 and 675. We will also deduct salary only for Rio. No salary before admission. After admission, Rio's salary is 15,000 per annum, but for 3 months it will be 1/4, which is 3,750 minus. So we get residual profit 61,650, and here we get 14,730. So this will be shared by all the partners, Maria, Rio and Sarah. Before admission of Sarah, obviously no share of profit for Sarah. 61,650 will be divided equally between Maria and Rio, so 30,825 each. But after admission it will be divided in the ratio 2:1:2. So 14,730 divided by 5. Rio's share will be 2,946 and Maria and Sarah will be double of that, so 5,892. And that completes the appropriation account. Before Sarah had been admitted as a partner, she had been earning a salary of 18,000 per annum. She had also received interest of 8% on her personal savings. Compare Sarah's income as a partner with the total income she would have received otherwise. And in 3 months, support your answer with calculations. We'll have to compare. If she's not admitted, how much would she earn, and now that she's admitted, how much she's earning, and compare. So before her admission, we'll be doing all calculations for 3 months, because the data from the appropriation account we have is just for 3 months. So all calculations will be for 3 months. So before admission, her income for 3 months, we have her salary, which is 18,000 per month. So 18,000 into 3 by 12, which is 4,500. And she would also receive interest on the amount that she invested as capital. If you go back to the question, she had invested 45,000. On this 45,000, she is expected to receive 8%. Had she not given it to the firm, she would have kept it in her savings account, where she would have earned 8% into 3 by 12, which is 900. So the total money that she would have made if she's not admitted to the firm is 5,400. After admission, income for 3 months, she received interest on her capital, and she also received share of profit. So let's see how much were the values. Interest on capital for Sarah was 675 and her share of profit was 5892. So taking the total, 6,567. So increase in income after admission is equal to $1167. Why do we have to show this? Because they're clearly telling you that compare, and yes, compare. The moment they tell you compare, you have to compare it and tell whether it is an increase after admission or decrease in income after admission. Question number 4. N Limited manufactures a single product at one of its factories. The company uses marginal costing. State 2 benefits of using break-even analysis. So break-even analysis, the most important advantage is that it helps you to be aware of the level of operations at which the business is going to make no profit, no loss. This level is very important for any business to know, because at least when they start the business, their aim would be to reach this level as soon as possible. And the second advantage is that it also gives the business an idea in the initial phases whether our business plan is feasible or not. For example, if the break-even point is very high and there is no demand in the overall market, there's no demand for those many number of products that we plan to sell to reach break-even, then obviously the business project is not feasible. So it helps in the business in comparing the break-even point to the overall market demand and understand the risks involved. Because if the market demand is much higher than the break-even point, then the risk involved is less. Otherwise, the risk involved will be high. Define the term fixed cost. Fixed costs are costs that do not change with the change in level of output. And since it is 2 marks, you could give some examples also. The following details are available for 1 month's production. Fixed cost is given, break-even point is given, selling price is given, margin of safety is given. Calculate the variable cost per unit. Okay, selling price is $20 and break even point is 8,000 units. So we can say that break even revenues is equal to 8,000 units into $20, which makes it $160,000 of revenue at which the firm will break even. And at break even, you know that the fixed cost will be equal to the contribution so that the profit becomes zero. So at break even point, contribution is equal to fixed cost, which in this case is given as 70,000. So when we know that revenue is 160,000 at break even, contribution is 70,000. So at break even point, variable cost will be equal to 160,000 minus 70,000, which makes it 90,000. And we know that the output is 8,000 units at break even. So variable cost per unit is equal to 90,000 divided by 8,000 units, which makes it $11.25 per unit. There are many ways of understanding the question. Approaching it differently also is okay. Just get the concepts right and just get the final answer right. Additional information: the directors that decide to increase the output by 20%, okay, all the output can be sold. The new machinery will be purchased at a cost of 72,000. New machinery will have a useful life of 5 years. Directors also plan the following: variable cost per unit obviously will remain unchanged. Selling prices will be reduced by 5% to ensure that all production can be sold. Cost of new machinery will be financed by issue of 10% debentures. Calculate the monthly revenue based on this plan. Now, in the previous part, they had mentioned the break-even point is 8,000, and they are also given the margin of safety at $80,000. If I have to convert this into units, I'll do 80,000 divided by 20, which is the selling price, 4,000 units. So how much is the actual output sold before the plan is introduced? 8,000 break even plus margin of safety. Why? Because margin of safety is actual minus break even. If you have margin of safety and you have break even, you can calculate the actual output before the new plan is equal to break even plus margin of safety, which is equal to 8,000 units plus $80,000 divided by $20, which makes it 12,000 units before the plan. And as per the new plan, so revenue after plan, quantity into rate. Quantity is 12,000, but they plan to increase it by 20%. So 120%, this becomes the quantity. And rate, currently it is $20. They plan to give a discount of 5%. That makes it $19. So if you calculate, you will get 273,600. Prepare budgeted marginal costing statement for 1 month based on this plan. Okay, so marginal costing statement. Revenues, we've already calculated 273,600. Then we will deduct the variable cost. Variable cost is the output multiplied by variable cost per unit, which remains unchanged. So 11.25 we already calculated in part C. So our revised output would be 12,000 into 120%. So 14,400 into 11.25, 162,000 That gives us the contribution, 111,600. From this we will subtract the fixed cost. Now under fixed cost we have existing fixed cost, 70,000. Then we have the cost of machinery, we'll call it depreciation on machinery, 72,000, which is the total cost of machinery that can be used for 5 years, but we want monthly depreciation, so 72,000 divided by 60, so that gives us 1,200. And for this we will also be spending on the interest on debentures, 10% on 72,000, but for 1 month, so into 1 by 12 we will get 600. So 71,800. Just let me show you the calculation for this. 72,000 into 10% into 1 month's depreciation, 1 by 12. So when we calculate the profit, 39,800. At another factory, the company manufactures 2 products, X and Y. Both products use the same material. The following information is available for 1 month's output. Selling price is given, material, labor, output is given, the factory's fixed cost is given. In April, the supplier of direct material informed that the company would be able to supply only 75% of the normal requirement. Prepare a budgeted production plan. Okay, basically this is a limiting factor question, and here the limiting factor is the direct material. Okay, they have said that only 75% of the normal monthly requirement will be available. What we can do is, first we'll calculate how much is the normal monthly requirement, and then we will calculate how much is available, so that later on when doing the question, after we've given the ranking, we will know how much output can be produced for each product. Okay, so what we can do is, now direct material is not given in terms of quantity, how much quantity is needed for per unit of product X and Y, but it is given in terms of money. We will follow that. So direct material cost for X is $10 into 5,000 units. $50,000 is the overall cost of raw materials, and direct material cost for product Y is $14 into 4,000 units, so 56,000. So direct material cost normal requirement will be 106,000. Availability of direct material is only 75% of 106,000, 79,500. Now let's do a statement showing budgeted production, or statement showing optimum production. Two products, so we'll have X and Y. Since the space is less, normally what I would do is I will write the selling price, direct material cost, direct labor cost, contribution per unit, and then find out contribution per dollar spent on raw materials, then give the ranking, then output. But since the space is less, what I'll do is I'll directly start with contribution per unit. It's okay because the numbers are directly given on top. Selling price is given, direct material is given, labor is given, so we can just subtract it and write the contribution per unit, which is $10 for product X, 32 minus 10 minus 12, and 44 minus 14, which is 30. 30 minus 19 is $11. Now, contribution per dollar spent on direct material. 10 divided by direct material cost for X is 10. So 1, and 11 divided by 14, which is less than 1. So let's say 0. It's going to 0.79. How did I get this? So for product X, what I did is contribution per unit divided by direct material cost per unit, which is $10 divided by 10, 1, and for Y it is $11 divided by $14, 0.79. Why do we do this? Because since material cost is limited, or material availability is limited, we want to see for every dollar that we spend on raw material, which product is giving us maximum contribution. Now that product may be giving us lower contribution in terms of contribution per unit if we consider the products individually, but we don't have to see contribution per unit of the products when there is a shortage of any raw material or any labor. We have to see which product is giving us higher contribution per amount spent on that particular material or that particular labor or that particular resource. Since we've gotten here our contribution per dollar spent on raw material, we can now give ranking, which is 1 and 2. So first we will use all our resources, which is the materials, in producing product X. What is the maximum output of product X that can be produced? 5,000 units. And for these 5,000 units, how much material cost would be spent, or how much money would be spent on material cost? 5,000 into $10 per unit, $50,000. Out of 79,500, we have already used 50,000 for X. So how much do we have remaining for Y? Only the difference, 29,500. So what I'm going to do here, direct material cost that can be spent for product Y is 29,500. And then how do I get the output? I will do 29,500 divided by material cost per unit of Y is 14. So let me calculate 29,500 divided by 14, 2107.14, but we are not going to consider decimal. Output can be produced only in whole numbers. So 2107 units. So that completes our statement showing optimum production. A director has suggested an alternative plan that the factory should produce extra units in May to make up for the shortfall of either product X or product Y. Any additional, basically here product Y, because product X we've produced entire 5,000 units. And how much is the shortage of product Y? The overall demand is 4,000 units, but we were able to produce only 2107. So the shortage will be 1893. The following information is available. Basically, these products can be produced if this is done. And okay, the month that we were talking about in the previous part was June. Now what they plan to do is they plan to make this shortfall in the previous month only, in May, and keep it as their stock so that they can use that in June. All the material requirements can be met in May. Basically in May there will be no shortage of material, but the materials has to be converted into finished products immediately as purchased. Okay. Overtime will be paid at 1.5 times the normal rate. Basically our labor cost per unit of Y will increase by 1.5 times. Extra units will be stored at a cost of 4,000. Basically our fixed cost will increase by additional 4,000. Calculate the profit or loss to be made on the extra units if the plan is implemented. Okay. So revenues will be 1893 units into selling price was, okay, what we can also do is, since the space is less, we can directly start by calculating revised contribution per unit. If you find this difficult, you could also say revenues generated from 1893 units, variable cost, which is direct material that does not change, remains 14, Labor cost, you will increase 19, you will increase it by 1.5 times, you will increase it to 1.5 times, and then you will get the contribution. You deduct the extra fixed cost, which is 4,000, you get the extra profit. But since space is less, what I'll do is I will find revised contribution per unit, which is equal to $44 minus $14 minus $19 in 1.5. So this 19 into 1.5, this is 28.5. So when we calculate the revised contribution per unit, we get as $1.5 per unit. So revised contribution, how much contribution are we going to make in total? So 1893 units into $1.5. 2839.5. And our additional fixed cost is 4,000. So our revised or additional loss, okay, this revised contribution, I will change it to additional contribution. Additional loss from this will be 2839.5 minus 4,000, which is a loss of 1160.5. So calculate profit or loss, we've done it. Advise the directors whether they should use the original product budgeted production plan in E or whether they should increase the production. Basically in part E, they were doing 5,000 of X and only the difference of Y, which is 2107. But in F, they decided to do full units of Y, make it in May and sell it in June. So the question is whether they should go for reduced production or they should produce full of Y also. Justify your advice. So financially, if you speak, obviously they should go for reduced production because producing the extra units of Y is leading to a loss of 1160. So financially, loss of 1160.5. So based on this, they should be going for the original budgeted plan. But then you will have to consider other factors also. For example, if you don't meet all the demands of your customer, they will go to your competitors. So there will be an advantage to competitors. Customers will shift. Maybe in the current month they buy from competitors, and then it might lead to permanent loss of customers for your business. So permanent loss of customers. Another problem that can happen is loss of orders for other products also. If the customer is going to your competitor, he might also consider buying other products from your competitors. So your demand for other products also might reduce, and it may lead to loss of orders and reduced profit to that extent also. And if you produce less output of Y, obviously labor will be idle. So loss of wages for workers due to non-production of product Y, they will also be morally very disturbed. It might affect the production quality, it might affect the production speed. So overall, if I would to suggest, my advice would be to go for the overtime production. Bear the financial loss for a limited period, but ensure satisfaction of customers over the long period. Ensure that labor is motivated at all times so that in the long run the business can succeed. So that completes the paper number 21. Now let's begin with paper number 22. Karen and Lee are in partnership, sharing profits and losses in the ratio 2:3. The following balances were available. Okay, trial balance is given. So admin charges expense, bank interest charges expense, bank overdraft is a liability. Capital accounts of the partners are given. Also current accounts are given later. Then in between we have carriage inward. Drawings are given. Insurance expense. Opening inventory is given. Loan from Lee. So this is the partner's loan. we have to see this in respect of the interest on loan. If the rate is given, we will take that. If rate of interest for partners loan is not given, we will take 5% as per Partnership Act. Non-current assets, cost is given, accumulated depreciation, provision for doubtful debts, opening balance is given, purchases, returns. Okay, returns are given in one row. So the one that you see on the debit side, this will be sales returns or return inwards, and the one that you see on the credit side will be purchase returns. Trade payables, trade receivables, and then we have a suspense account. Probably their trial balance did not match. Credit was greater than debit, so they put the difference on the debit side. Let's see if we find an adjustment that can correct this error and remove the suspense, it is good. Otherwise, at the end, we'll have to see what to do with the suspense. Following additional information is given: 28th Feb 2022, which is at the end of the year. Inventory had been valued at 21,220. This figure included some damaged items which had a cost of 1320. So this entire inventory is valued at cost. So this 21,220, this had some damaged items, and the cost of these damaged items is 1320. And then we have the others, which is a difference. These damaged items had a sale value of 2480, but the damaged items would be needing repairs of 1300. So how much would be the NRV? Selling price 2480 minus 1300, 1180. How much is the cost? 1320. So definitely we will have to value the inventory not at cost but at NRV. So how much is the difference? $140 we will have to reduce from the closing inventory to account for this. So the closing inventory that you will consider will be 21,220 minus 140. So 21,080. In Jan, an error had been made in recording the returns inwards 410. This amount had been credited to return outwards. Okay, return inwards should have been debited, but return outwards was credited. So what we can do is we can go to a trial balance. The amount that you see here, 3930, this includes extra return outwards 410. We'll have to remove it. So the correct figure for this will be 3520. And this 2200 that you see, this we'll have to include 410 in this. So 2610. So that way we've corrected our returns. And also when you do this, automatically this suspense account goes away, because then the trial balance will now match even without the suspense. If you have a doubt on understanding this, just try to do the rectification entry for this error and you will understand that suspense account is being debited by 820 in the rectification entry. Insurance includes 1410 paid for 3 months ended 30th April, which means we've paid for Feb, March and April a total of 1410. But out of this, only Feb is in the current financial year, March and April in the next financial year. So prepaid will be 1410 into 2 by 3. The loan from Lee had been arranged on 1st November. If it is arranged on 1st November, it means it is used for November, December, Jan and Feb. Just 4 months out of 12. It was agreed that Lee should be entitled to interest at 6%. Interest rate is given. So we'll consider this. No entries had been made. What is the entry for interest on loan? Interest on loan debit and partner's current account, which is a Lee's current account, credit. So this interest on loan will go as an expense in the income statement, and the partner's current account credit side you'll have an entry. What will be the calculation? Loan amount given in the trial balance is 10,000 into 6% into November, December, Jan, Feb. 4 by 12 we decided, yeah. So 200 will be the interest on loan. Provision for doubtful debts is to be increased to 310. Currently, if you see, it is 260. So 310 minus 260. In the income statement, you will have an expense of $50. Non-current assets to be depreciated 20% using reducing balance. So cost is 160 minus accumulated depreciation 56,000. No other adjustment. So 104,000 into 20%. Which will be 20,800. So that way all the adjustments we've understood. So we are supposed to prepare the income statement. First you will calculate the gross profit. then you will calculate the net profit. In the net profit, make sure you also consider the interest on loan when calculating. So you will get it. In part B, we are supposed to prepare the current account. But before the current account, we've always seen that we need to prepare the appropriation account. But there's no requirement to prepare appropriation and there's no space to do the appropriation. Is it really needed? In appropriation, what do? We start with the net profit, we add interest on drawings, we subtract interest on capital, we subtract salary. But if none of these is mentioned in the agreement or there's no agreement, all of this turns to zero. So in that case, the net profit will be shared directly in the profit sharing ratio. So in this case, it is 2:3. So if you read the question, nowhere they've mentioned anything about these details, interest on drawings, interest on capital, salary. So we assume all of this to be zero. And now it's easy to prepare the current account of Lee. Okay, let's see where is balance brought down. Current account Lee 1880 on the debit side. So balance brought down will be on the debit side, 1880. Then on the credit side, you will have to record all those transactions that the firm is contributing to Lee. Firm is supposed to give to Lee, which includes interest on loan. If there was interest on capital, salary, I would have recorded that also, but there's none. So share of profit, which you will get from the income statement, whatever net profit you get, take it as divide into ratio 2:3, which out of which Lee's share will be 3/5. So 3/5 into the net profit, whatever you get, that you can record it here. On the debit side, we will have drawings, which is given in the trial balance. Let's see what's the drawings. 19,900. Interest on drawings is obviously not there, and then you will get the balance carry down, depends which side is more or less. Continuing further, additional information. Partners have been considering making a more detailed agreement to include the following terms: interest on drawings 10%, Karen to receive annual salary of 8,400, profits and losses in the same ratio 2:3. Calculate the increase or decrease in Lee's current account balance, assuming that the new agreement had been in use. So now you'll have to prepare a revised current account of Lee. On the debit side, same balance brought down, 1880. Now on the credit side, this time you will have interest on capital, you will have interest on loan as usual, or as per last time 200. You will also have salary is not there for Lee, so share of profit. Now this share of profit will be different now because we have to consider all the appropriations before distributing the profit. So you'll have to do it separately. You'll have to take the net profit minus the total interest on drawings, which is the total drawings of both the partners, into 10%, plus the interest on drawings minus the interest on capital, which is total capital of both the partners, into interest on capital. Okay, it's still not there. Okay, fine, we can just ignore that. Salary will be deducted 8,400, and then whatever profit you get, which is the residual profit, that you will do 3/5, and then you will enter that here. On the debit side, as usual, we will have drawings 9,900, and we will also have interest on drawings for this partner 1,990, and then you will get your balance carry down. Depends on the debit or credit, will depend on these amounts also. Question is to calculate the increase or decrease. So you'll have to compare the balance in the current account before this, and then you have to state whether the credit balance in the partner's current account is increasing or decreasing. Karen and Lee had also considered operating as a limited company. Explain one advantage of operating as a partnership rather than a limited company. Well, if you have a partnership, some advantages are that you can have your financial statements not disclosed because you can have it private, because there's no requirement for a partnership to publish their accounts. But for limited company, if they raise funds from shareholders, from general public, they will have to have published accounts. So this is one advantage. Another advantage can also be that forming and running a partnership firm is easier and cheaper compared to a limited company, because legal requirements for a company are much higher, and eventually even because of this also the cost also turns out to be higher of opening and operating a limited company. So any one advantage you can explain. Two advantages of operating as a limited company. Okay, the best advantage of operating as a limited company is the limited liability of the owners or shareholders. They are only liable to the extent of capital that they've agreed to contribute towards the business. More than that, their personal assets cannot be used to discharge liability of the business. And also, raising finance is easy for a limited company, especially raising huge amount of money, huge finance, because banks are also more willing to give money to limited companies. Plus they have also access to the money of general public. They can sell shares, sell debentures and get money from public also. The partners are concerned about the business's liquidity position. Karen believes that the problem arises because the business holds too much inventory. She suggests that the credit purchases should be reduced for the next 3 months to ensure inventory levels are lowered. Okay. For 5 marks, they're asking you advise Lee whether or not he should accept Karen's suggestion. So what you can do is you can write down 2 advantages of having lower inventory, 2 disadvantages of reducing the inventory levels, and then 1 mark you can have for advice. Advantages of lower inventory will be obviously more working capital available in the business, or less requirement of working capital, more liquidity available. That's a better way of saying it. More liquidity available, and lower cost of storage. When inventory is lower, storage cost will reduce, and less cost of obsolete inventory, which is if inventory you buy and you're not able to sell it, it gets spoiled, it gets damaged, then that cost is also reduced. Disadvantages: the business may run out of stock when the customers need the product, so loss of customer or loss of revenue. You can also say that there will be a fall in the reputation of the business. If a business has a reputation of usually keeping all items in stock, if the reputation falls, customers may not even try to come to this business in future and directly go to the competitors. So that you can say loss of reputation for future revenue. Okay, one advice that Lee would give: before giving advice, let's see how much is the inventory, how much overall cash they have. Then it's better to give an advice, because let's say I would be looking at the cash and cash equivalents mainly. If the business has good cash and cash equivalents, then I may not be worrying so much. In this business, if you see, they have a bank overdraft. So yes, there you could consider this possibility of reducing the inventory level. Inventory is 21,220, and if I look at the trade receivable, that's 31,210. Fine. So we can say that Lee can accept Karen's advice. And while giving a reason for this, you can say that as it will improve the rate of inventory turnover of the business, assuming that revenues will not be affected. So you can give such an advice and it will be okay. We Limited owns various non-current assets. Non-current assets depreciate due to number of factors, including wear and tear. State 2 other reasons. So you can say change in technology, which can, in other words, is also called obsolescence. You can mention that. You can say time factor. Some assets are available for limited time, so even if you don't use them, because of time they depreciate in value. Then additional information, business must apply the consistency concept when accounting for depreciation. Describe the consistency concept. As per the consistency concept, when a certain method is chosen in any area of accounting, then that method should be applied every year consistently. This ensures better comparison of accounting information. Company's financial year ends on 31st December. Property was purchased on 1st Jan 19 at a cost of 850,000. Property is depreciated 5% on cost. Okay. On 1st Jan 2021, directors decided to revalue the property at 1.2 million. So first we will have to depreciate it for 2 years. So 850,000 into 5% into 2, because 2019 and 2020. So $85,000 is the accumulated depreciation on this date. So on this date, what will you do to revalue? First of all, you will debit the property with the difference. Currently, they want it at 1.2 million and the current cost in the books is 850. So by the difference 350,000, they will have to debit the property. They will also have to close the accumulated depreciation on property. Whenever an asset is revalued, the accumulated depreciation on that asset is brought down to 0. So 85,000, and the credit will have to be given to revaluation reserve, which is 435,000. If you have to check whether this revaluation reserve amount is correct or no, you can compare the net book value of the asset and the market value or the fair value. How much is the net book value of this asset? 850,000 cost minus 85,000 accumulated depreciation, so 765,000, and market value is 1.2 million. So just take the difference between these two values. You will get it as 435,000, and it means our revaluation reserve amount is correct. Additional information, furniture and equipment was purchased on 1st Jan 19 at a cost of 140,000. Depreciation is 10%, reducing balance. On 1st September 2021, the director sold furniture which had a cost of 21,000. Full year's depreciation charge in the year of purchase, none in the year of disposal. Calculate the depreciation charge for the year ended 31st December 2021. Okay, so out of the overall cost of 140,000 for furniture and equipment, the disposed of cost of that asset is 21,000. So it means the remaining or unsold is 119,000. This is on 2019. So on this, if I calculate depreciation for year 1, which is 2019 depreciation, depreciation rate is 10%. So 11,900. So 107, 100 on this. Again, year 2 depreciation, which is depreciation for 2020, 10,710. So 96,390. This is the net book value on 1st Jan 2021. So for the year ended 31st December, what we're going to do is we're going to do 30 into 10%. So 9639. That's the depreciation charge, because no new asset is purchased. If new furniture and equipment had been purchased, we could have recorded the depreciation on that also. We could have added that also to 9639. So when presenting this answer, what you can do is cost of asset unsold in 2019. Okay, cost of asset in 2019, remaining unsold in 2021, to make it more clear, 119,000. Then net book value of this asset on 1st Jan 21, 119,000. Since depreciation is 10%, I can say multiplied by 90%, multiplied by 90%. So I'll get depreciation deducted for 2 years and directly net book value, which we get 96,390. and then easily you can calculate depreciation for 2021 is 10%, 9639. There are other ways of also doing it. Let me quickly tell you. 140,000, what you do is you start depreciating the whole thing for 2019. You also depreciate it for 2020. Then on 1st Jan 2021, okay, let me calculate. On 1st Jan 2021, you get net book value of the entire lot of asset 113,400. From this, you will deduct the net book value of sold asset, which is 21,000. When I depreciate it for 2 years, how much is the net book value of the disposed of asset? I'll deduct that and I will get the same thing, 96,390. Both approaches are okay. Motor vehicles were purchased on 1st Jan 2020 at a cost of 84,000, depreciated 20%, reducing balance. On 1st November, new motor vehicle was purchased at a cost of 44,000, check for 17,000 was given, and the balance was covered by part exchange. And the cost of the asset that was given away, that had a 40,000 on 1st Jan 2020. Overall cost was 84,000 of all the motor vehicles. Out of this, only 40,000 is disposed of in 2021. Remaining is still using. Prepare motor vehicle account for the year 2021. So balance brought down that we bought last year, 84,000. Now disposed of asset or disposed of motor vehicle had a cost of 40,000. So on the credit side of motor vehicle account, 40,000, and we bought new asset. We paid a check of 17,000. So I'm going to record bank 17,000, and the remaining value, for which we did not pay money, but we got the value in terms of the asset that we gave, that will have to be recorded as disposal. The difference, overall cost of the asset was 44,000, which is given here. We paid 17,000 from bank account. So 27,000, it means, is the value that we got for our disposed of asset. So 27,000. So just take the totals and balance carried down on the credit side. Question number 3. N Limited is a trading company. Statement of financial position is given. Assets are given. Total assets. Okay, this is the balance sheet. Okay, assets are given. Then equity is given. Non-current liability. Current liability is given. Additional information: purchases 600,000. Out of this, 80,000 was credit. Credit sales were 30% of all the sales. Sales is not given directly, but they tell you that out of total sales, 30% was credit. Gross margin was 40%. Company's gross profit is 420,000. Okay, if gross profit is 420,000 and gross margin is 40%, I can say that my total revenue will be 420,000 divided by 40%. So that makes it 1.05 million. Company's net profit is 182,000. Okay, no interest was charged on bank overdraft. Okay. Part A, calculate the following ratios. Okay, trade payables turnover in days. To calculate this, you will have to take the trade payables, average trade payables. Usually in the formula it is average trade payables, which is opening plus closing divided by 2. But when opening and closing trade payables are not given, we take closing divided by only credit purchases. Remember, trade payables arise only out of credit purchases and not total purchases. In days, so I'm multiplying it by 365. Trade payables is given in the question in the balance sheet, 42,000. Credit purchases is 80% of total, which is 600,000. So 480,000 multiplied by 365. You can put a star mark here and say credit purchase is equal to 600,000 into 80%. It's always better to show all the calculations that you make. So 42,000 divided by 480,000, 365, 31.9375. They have not stated how do you round it off. Always round off to the next day in case whenever the question is in days. So 32 days. Trade receivables. So trade receivables divided by again credit sales into 365. Trade receivables is given in the question 30,000. Now credit sales is only 30% of the total sales. Total sales we got it as 1.05 million. So 30% of that 315,000 into 365. Again, you can show the calculations for here and then you can calculate whatever other days. It is coming to 35 days. Then we have return on capital employed. What is the formula? Profit from operations. Never take net profit here. You have to take profit from operations divided by capital employed. Just don't take capital here. Always say capital employed multiplied by 100. Profit from operations is not given directly, but they've given us company's profit, which is the net profit. How do you calculate net profit? Net profit is equal to profit from operations minus the finance charge. In this case, what's the finance cost? 8% of 250,000, which is the debentures issued. So 8% of 250,000 is 20,000. We don't know profit from operations, and net profit given is 182,000. So now can we calculate profit from operations? Yes, we can calculate. It will be 202,000. And the capital employed is equal to, okay, you can mention it here, capital employed in bracket, equity plus non-current liabilities to make it clear. In the balance sheet, how much is the total equity? 1,282,000 plus how much is the non-current liability? 250,000, the debentures. The whole thing multiplied by 100, whatever you get. Since they're telling you two decimal places here, so it comes to 13.19%. Make sure you show the calculation of 202,000, put a star mark and show how did you get it. The next is to calculate the non-current asset turnover, for which we will be needing non-current assets, which is 1520, and turnover is 1.05 million. We've already calculated. So non-current turnover formula is net revenues or net sales divided by the net book value of non-current assets. Please write the whole thing, don't write abbreviations in exam. That's it. Whatever you get, it'll always be measured in times. Net revenue was 1.05 million divided by net book value of non-current assets was 1.52 million. So 1.52. So we get 0.69 times. Here also they're telling you two decimal places. So accordingly you'll have to do. Explain the importance of non-current asset turnover. So non-current asset turnover measures how efficiently the business is using its non-current assets to generate revenues in the business. See, it's very easy for a business to take loans and expand, buying a lot of non-current assets. But after buying the non-current assets, are they making proper use of it? Are revenues increasing in the coming years? That is very important. So this ratio helps you determine that. And once you get this ratio, let's say in this case it is 0.69, you can compare this to other competitors. If competitors' non-current assets turnover is higher than this, then it means that this business is not making the best use of its non-current assets. All of this you don't need to write, you just need to explain the importance, which you can say that it explains or it helps the business to understand the efficiency with which the non-current assets is being used to generate revenues. Explain one reason why shareholders will be interested in financial statements of a company. There are many reasons that you can write. Shareholders would want to know the profit made for the year so that they can understand the current and the future profit potential of the business, or they may be interested in understanding the liquidity position of the business. Is there enough liquidity? By calculating, they might calculate current ratio, quick ratio, or they might be interested in understanding the efficiency of the business, or they might would want to compare it with other competitors to decide where they want to invest their money. Any of these points you can write. Question number 4. F Limited is a manufacturing company which uses absorption costing at one of its factories. Factory has 2 production departments and 2 service departments. Okay, budgeted costs have been allocated and apportioned. What do you mean by the term allocation and apportionment? Allocation you do for fixed overheads or for overheads that can be identified with a particular cost center. For example, if let's say it's a machining department and there is an overhead that is being generated only by machining department, so what you'll do, you'll take up that overhead and put it under machining department. You will not be confused as to where to divide this overhead. Will it be divided between all the cost centers or just machining department? Very clear. So allocation means when a particular overhead can be identified with a particular cost center, that overhead will be charged to that cost center. That's called allocation. Apportionment happens when you are confused as to this overhead has been generated in what proportion by multiple cost centers. So there may be an expense that is generated by many cost centers together. So then you use or then you charge these overheads to these cost centers using a suitable basis. That is called apportionment. State one benefit of using absorption costing. It helps the business to calculate the total cost of the product and eventually arrive at the selling price. Because if a customer is asking you the selling price of the business and you don't use absorption costing, you're using, let's say, marginal costing, you'll not be able to arrive at the correct selling price for the product. Because if you use marginal costing, you might end up ignoring the fixed cost and you might understate the selling price. State one limitation of using absorption costing. It is good for calculation of selling price or for presenting financial statements, but when it comes to decision making, absorption costing is not very useful. So it does not help in the decision making process to the management. Then some information is given. Budgeted cost for April is given. These cost centers are there. Production, service. Under that, total overhead cost already given. Okay, service department overheads are apportioned to production department on the following basis. Maintenance cost has to be divided between 3 departments, but stores cost is to be divided between only 2 departments. So now here you will be confused whether to distribute stores first or maintenance first. Basically, stores has to be given to 2 departments while maintenance has to be given to 3 departments. So in such cases, always do maintenance first and second stores. Why? Because maintenance cost will also go in stores cost and eventually total stores cost you will divide between other production departments. So whichever department is giving service to some other service department, that you will do first. So first you will do apportionment of stores in the ratio 60, 30, 10, and here obviously it will get deducted from maintenance. Sorry, I said stores. It has to be maintenance. First you will apportion the cost of maintenance between assembly, finishing and stores, and then whatever you get, you will take a subtotal for all 3, and whatever subtotal you get for stores, that will then be distributed between assembly and finishing in the next row, and then that will be deducted from stores. So ultimately this stores and maintenance become 0 and all the cost is then accumulated in the assembly and finishing department. The following additional monthly budget information is available about production departments. Assembly, labor hours, machine hours are given. Finishing department, labor hours, machine hours are given. Why is this information given? You have to see at these working hours and decide which department is labor intensive and which department is capital intensive. For assembly, if I see, machining department is greater than the labor department. So assembly automatically becomes a capital intensive department. So for overhead absorption rate, we are going to use the machine hours. But in case of finishing department, the labor hours are much higher than the machine hours. So this becomes a labor intensive department. So we are going to use labor hours for calculating the overhead absorption rate. So for assembly department, whatever you're supposed to calculate the overhead absorption rate, whatever budgeted overheads you get. So budgeted overheads that you get as per D under the assembly column, that you will divide by budgeted machine hours, which is 1430. Okay, numerator I don't know, divide by 1430, and then whatever you get, since it's 2 decimal places, so dollars whatever point into 2 decimal places. Same way for finishing department, you are going to use the budgeted overheads of the finishing department as per answer D divided by budgeted labor hours, which is 840, and then again 2 decimal places you'll calculate the overhead absorption rate. In April 2022, production was less than the forecast figure. Assembly department's actual overheads were 285,400. Actual labor hours are given, machine hours are given. They're telling you calculate the under absorption and over absorption for assembly department. So first of all, we will have to calculate the absorbed overheads. What is the formula? Actual actual machine hours, because assembly department is a capital intensive department. So actual machine hours multiplied by the overhead absorption rate as per part E. Whatever you get here, you will use that rate here. And actual hours is 1310. Now in this question, if you see, they're giving you actual labor hours also and machine hours also. Labor hours is just given to confuse you. You don't have to use it. If they had asked question for finishing department, then we would have considered the labor hours and we would have ignored the machine hours. So whatever you get here, absorbed overheads in terms of dollars, that you will compare with the actual overheads, which is 285,400. If absorbed is greater than actual, it will be over absorbed. If absorbed is less than actual, it will be under absorbed. At another factory, the company manufactures 2 products. This factory uses marginal costing. Direct material is given, labor is given, okay, fixed cost per unit is given and number of units are given, selling price per unit is given, okay. Company has a major customer who usually orders 5,000 units of X each month. This order is included in this 8,000. In May, customer has asked for 9,000 units. Earlier he was asking for 5,000, but now he's asking for 9,000. So they want plus 4,000 extra. If it is not possible to supply extra 4,000, the customer has informed the director they'll place the entire order and all future orders with another company. So basically company loses this customer forever if this extra order is not given. The directors have 2 options. Option A, stop the manufacturing of product Z. Basically the 4,000 units of product Z, stop it, and then all labor hours will be devoted for product X. Company will be able to complete all normal orders for product X and increased order fine. Workforce will require some retraining and fixed cost of 3,000. So this is a fixed cost. Fixed cost, but don't ignore it because this is additional fixed cost. Fine. Okay. Option B, maintain normal production levels for X and Z. Refuse the customer's order and reduce the selling price of product X by 5%. Okay, so they want to try and sell the all units of product X because this customer will be lost. So in order to do that, they are reducing the selling price by 5%. Calculate the overall profit to be made if in May 2022 under option A and option B. Okay, let's see. What we'll do is we'll do it in a form of a column. Okay, for option A, okay, there is no product Z, so we just need one column. So profit statement. Option A. Total revenues. 8,000 is the normal production plus 4,000 extra, so 12,000 units into $24. $288,000 will be the revenue less variable cost of production, 12,000 units into material cost and labor cost, which is $15. So 180,000. So contribution 108,000. From this we will subtract the fixed cost. Okay, fixed cost, one is the existing fixed cost and then the additional fixed cost. Let's calculate the existing fixed cost first. Okay, what we'll do is we'll present it in a better manner. Under that, existing, additional. For additional we will have 3000. Existing fixed cost we'll calculate, and once we do that we'll get the profit. So for existing fixed cost, you can put a star mark here. Existing fixed cost will be for product X 8,000, and fixed cost per unit for product X is $5. So 5 into 8,000. For product Z, 6 into 4,000. So 40 plus 24, 64,000. Now, even though product Z is not being produced, or they've stopped producing product Z, don't ignore the fixed cost of product Z, because that fixed cost will have to be absorbed by product X now. The fixed cost still remains in the business. So 64,000 on top here, 67,000 total fixed cost, 41,000 is the profit under option A. Now we'll do the profit statement under option B. What we'll do is, since they're selling both product X and Z, I will do it in this manner. Any other presentation is also okay. Revenues. For product X, now they're going to sell only 8,000 units into 24, but there's a discount of 5% on the selling price. So if we remove the discount, the net selling price is 22.8, and this into 8,000 is 182,400. We'll put a double star mark and show the calculation here. Revised sales, $24 into 8,000 into 95%. For product Z, it's going to be 30 into 4,000, $120,000, and totally it is going to be 300, 400. Sorry, 300 to 400. Less variable cost. For product X, it's going to be 6 plus 9, 15, material plus labor, into 8,000, which is 120,000. For product Z, it's going to be 9 plus 9, 18, 18 into 4,000, 72,000. So 192,000 total. That gives us the contribution for each product, and in total, product X, it is going to be 62,400. Product Z, it's going to be 48,000. And total production is going to be 110,400. From this, we will deduct the fixed cost. Already calculated below, existing fixed cost, just deducting that 64,000. So we get the profit for the year. So 46,400 is the profit for the year. That's it. They just told you to calculate the profit. We've done it. Going to the last part of this question. Advise directors which option they should choose. Justify your answer by discussing both financial and non-financial, 7 marks. So what we'll do is, we will state firstly financial reasons, we'll compare. Then we will have to state a few non-financial points for each, and then we'll finally give the advice. So from financial point of view, option B is generating higher profit, and option B is generating lower profit. So from financial point of view, option B is better, considering the non-financial factors. Now, one problem with this option B, if you ignore the regular customer or the major customer, is future orders from the major customer will be lost. And no business would want to lose a major customer, because then it might affect the revenues. Second thing is, even though they can sell all the product X, all the units of product X by giving 5% discount on selling price, the question is, how far is this sustainable? So can the 5% discount be or is sustainable? Can all the customers continue buying all the products of this product X, all the units of product X, can they continue buying? So this is one question that we will have to ask. Another advantage of having or of going option B is that customers of product Z are also satisfied in case of option B. When it's in option A, that is those customers are also lost. It might create a bad reputation for the business. And then finally, we'll give an advice. So I would go for option B because okay, if you choose option A, you'll have the major customer, but you will lose a lot of other regular customers of product Z, which is bad because you're dependent on that one major customer, which might leave you anytime, and then the business will be affected. So I would go for option B because in this case the business is not dependent on one major customer, and hence option B is better, at least for the time being, because for now the customers are accepting the discount, buying all the products. So at least for the time being, option B is better. This is how I will write. So we've completed paper number 22 also. Now let's begin with paper number 23. Question number 1, K Limited's financial year ended on 31st December 2021. Company's income statement for the year ended has already been prepared. Following information is given after preparing the income statement. 8% debentures are there. Then bank overdraft is there. Dividend paid. Okay. Inventory. This will obviously be the closing inventory because income statement is already prepared. Non-current assets are given at cost and accumulated depreciation on that. Ordinary share capital, other payables, other receivables. Profit for the year. This is after preparing the income statement. What is the net profit? Retained earnings are given. Share premium, trade payables and trade receivables. On 1st July 2021, that is in the middle of the year, directors had made a rights issue of 1 ordinary share for every 2 ordinary shares in issue. The rights issue was made at 0.35 per share. Note that ordinary share capital that they've given you, this is on 31st December. And the rights issue has been done on 1st July. So what does it mean? It means that the rights issue has already been included in this share capital, and after that they're giving you the share capital. Just keep that in mind. First, part A, calculate the profit from operations. So you know that net profit is equal to profit from operations minus the finance cost in the income statement. So net profit for the year is given 99,400. Profit from operations we don't know, but finance cost we can calculate. 8% debentures, 120,000 is the value. So 8% into 120,000 is 9,600. And in this equation, if you want to find X, you can transfer 9,600 on the other side and add it to 99,400. You will get 109,000 as profit from operations. Part B, calculate the amount raised by rights issue on 1st July 2021. If you want to calculate the amount raised by rights issues, then you will have to first calculate the number of shares that were issued, and this you will have to multiply by the issue price. Issue price is $0.35, but we need the number of rights shares issued. Now question says that directors had issued 1 share for every 2 ordinary shares already held. So the ratio was 1:2. For every 2 shares, 1 additional share would be given. So do we know the number of ordinary shares held before the rights issue? We don't know directly because the 480,000 shares that you see here, that is after the rights issue. So what we can do is let the number of shares before rights issue be X. This is a way of doing it. There are other ways of also doing it. So see what way is suitable for you. So rights issue, okay, rights shares issued will be 1/2 of X, or I can call it X by 2. So total shares after rights issue is equal to x plus x by 2, which is this one and this one. But do we know the total number of shares after the rights issue? Yes, 480,000 is the share capital, so 480,000, but the face value is 0.25, so that we will divide by $0.25. We will get the number of shares, which is equal to 3x by 2 if I simplify this. So that helps me to get x is equal to 480,000 divided by 0.25, so 1920 000 into 2 by 3. So 1.28 million number of shares. This is before the rights issue. So rights shares issued is equal to half of this, which is 640,000, and the amount raised will be 640,000 into dollars, 0.35 dollars, 224,000. So this is how you do it. What mistake students would make normally is that they would forget this fact that 480,000 share capital is after the rights issue, and on this only they will issue right shares. Just keep this in mind. A presentation can be a little more easier. You may not do so much in detail if you understand it properly. Like let's say you have everything in your mind. What you can do is alternatively you can say that the number of ordinary shares before rights issue is equal to into 2 by 3. Basically directly start from this step. Examiner will understand that you understand the concept, but if you don't understand it directly, you can always follow this method. It's also easy. Statement of changes to equity is easy. Opening balances are given in the trial balance. Then we have rights issue. Okay, in rights issue, the amount received is 224,000, but how much of it is face value and how much of it is share premium? So 640,000 into 0.25 you will get the face value, and into 0.1 you will get the share premium. So you'll have to write it in separate columns. The face value will appear here and the premium part will appear here. Then profit for the year is given, that will appear in retained earnings column. Dividend paid is there, that will appear as a negative number in retained earnings column. Fill in the totals and then you can show the closing balance. Statement of financial position is very simple. All the values are given. You'll have to present the assets, then the equity, non-current liability and current liability. So you can do it and check from the marking scheme. There's nothing really difficult in that. Explain the meaning of each of the following terms: revenue reserve and capital reserve. The revenue reserve means profits earned or retained in the normal course of business operations or through the normal trading activity of the business. So every business is set up for certain purpose, to deal in certain products, to provide some services. Whatever profits that are earned in this normal activity, all those are a part of revenue reserves. So since it is 2 marks, you could write one of this point: profits earned and retained in the normal course of business activity. And then you can also say these profits are available for distribution as dividend. Capital reserve, you can say that these are profits that are earned in transactions or activities other than the normal business activity, and these are not available for distribution as dividend. If they ask you example, you could give examples like general reserve, retained earnings, and for this you can say revaluation reserve, you can say share premium if they ask you examples. The directors of K Limited will require additional finance in 2022 to cover the cost of opening a new branch. They're considering two options: further rights issue and make an issue of 8% debentures. Advise the directors which option they would choose and justify by discussing both the options. So for option 1, since it's a rights issue of ordinary share, we can say that it's a permanent source of capital. It is less risky because since the repayment of capital is not obligatory, since no mandatory interest payments are required, so it is less risky in the business. And then another point, you can also say that the success of rights issue, or for that matter success of any issue of shares, will depend on the demand for shares, whether the shares will be subscribed or no. Because if the shares will not be subscribed, the company will not get the finance that is required. So that you can say for option 2. Option 1. Option 2, you can say that principal and interest have to be paid irrespective of the financial conditions of the business. Hence, it contains a high risk element. But there's also this fact that raising money through debt is a cheaper option compared to equity. Why? Because you'll have to just pay a fixed rate of interest, and then whatever are the extra profits that the business makes, that all of those can be enjoyed by the shareholders. But in case of your share issue, the cost of capital is high because the expectations of shareholders are high, and extra profits that are earned, they all have to be divided between the shareholders. So compared to debt, equity is an expensive source of capital. Then at the end, advice, I would say you could suggest rights issue. Obviously it's less risky and less even if the business model of expansion is not successful, there's not a lot of pressure on the company to repay the source of the amount of capital. So I think the rights issue can be given as an advice, but it would not be wrong even if you advise on debentures. So it's completely okay. Just give a proper justifying statement, whatever you justify. Question number 2, Rakesh prepared his business's end of year financial statements. Define the following accounting concepts. Give an example of each. Matching. Okay. Matching concept says that the expenses or costs have to be appropriately matched with the incomes so as to arrive at the correct profit. Example are many. You could give example of recording accrued expenses, prepaid expenses, or even accrued or prepaid incomes. You could give an example of recording depreciation. All of these are examples of matching. Then going concern. Going concern assumes that the business will continue to operate for an indefinite period of time. There are no intentions to close down the business. Example is the process of capitalizing non-current assets or treating non-current assets as a capital expenditure and showing them in the balance sheet at the cost less any accumulated depreciation. That's an example of going concern, because if going concern is not there, you can't show your non-current assets at cost in the balance sheet. You have to show them at their market value. Materiality states that all the transactions should be recorded and presented in a way that is material to the users of financial statements. Example would be to treat non-current assets of small value. You may treat them as revenue expenditure itself. For example, stationery items, you don't have to treat them as capital expenditure even if you plan to use it for more than 1 year, because the amount is insignificant. Another example of materiality is when preparing income statement, the immaterial expenses or immaterial items can be grouped together, clubbed together to show them as one line item, because again their amount is insignificant and immaterial, and anyone reading the income statement may not be really concerned about these small value expenses or transactions. Then additional information On 30th September, Rakesh decided to write off irrecoverable debt of 730 from the account of JD Supplies. Journal entries required. It is easy. Irrecoverable debt will be debited. JD Supplies will be credited. Rakesh receives rent from tenant. Following details are available for the year ended 30th September 2021. At 1st October 2020, tenant owed rent of 1200. Since this is an income and this is accrued income, so this also automatically becomes an asset and hence will be shown on the debit side. So balance brought down 1200. During the year ended 30th September 2021, the tenant paid rent of 9000 by bank transfer. So this is the receipts on the credit side, bank 9000. Then at 30th September 2021, a rent of 1125 had been received in advance. So this is a liability. Balance brought down next year has to be on the credit side. So this year balance carried down will be on the debit side, 1125. Why have I left one row here? For the income statement value. So taking the total on the credit side, 9000, and the difference 9000 minus 2325, so 6675 will be income statement. The business owns equipment which cost 24,000 when it was purchased on 1st October 2018. The business is polished to provide 20% reducing balance. Account is needed for the year ended 30th September 2021. Basically for the third year. So for the first 2 years we don't need an account. So we can directly start with balance brought down. Now this will be 2 years depreciation using reducing balance. So first year 24,000 into 20%. 4,800. Then for next year 19,200 into 20%, which is 3840, so 8640. And then for the third year, income statement on the credit side, 24,000 minus 8640, so 15,360 into 20%. So we have 3072. So balance carried down 11,712. Question number 3. Nibras purchases and sells goods for cash and on credit. Control accounts are used to check the accuracy. So details of purchase ledger control account are given. Opening balance. Transactions are given. Cash purchases, payments, discount received, purchase journal. There were no overpaid. Okay, I think normal purchase ledger control account is simple to do. So I'll directly go on to the next part. But yes, I'll just talk about this. Cash purchases is given 18,540. This will not be recorded in the purchase ledger control account because this is not a transaction that is entered in the purchase ledger in the supplier's account. It is entered in the cash book and in the purchase account in the general ledger. Hence, this will not be in the purchase ledger control account. Rest transactions will be recorded. Okay, so this will be on the credit side, balance brought down. This will be on the debit side, balance brought down. Payments on the debit, discount received on the debit, purchase on the credit, returns on the debit, and contra on the debit, and then you can find the balance carried down. So the balance carried down is 23,200. Okay, let's go to the next section. On 31st Jan 2022, following information was available concerning trade receivables. So the balance of sales ledger control account, total of balances in the sales ledger. Since these two are not the same, obviously there are some errors in debtors accounts in the sales ledger, or somewhere even probably in the sales journal or sales returns journal, we don't know. Let's see. Following errors were discovered. When corrected, the total of balance in the sales ledger agreed with the balance of sales ledger control account. So 4 errors are here. An irrecoverable debt of 540 had been recorded as 450 in both the general ledger and the customer sales ledger. So this will be corrected both in the control account and in the sales ledger, both places. Total of return inwards 1390 had been omitted from the sales ledger control account only. So they don't tell you that it is omitted from the customer's account also. So this correction will only be done in the control account. Balance of a customer's account had been understated, so this will be rectified in the sales ledger. Credit note 90 issued to a customer had been recorded correctly in the sales returns journal but posted to the debit side of customer's account. So no mistake in the control account, so only in the sales ledger. Calculate the correct balance of sales ledger control account. You could either do it in form of a T account or you could do it in a form of a statement, because they've not told you to prepare the sales ledger control account, just correct balances to be calculated, but we'll do it in a form of T account. Balance brought down 25,310. First error 540. Since original amount was 540 and recorded in the control account is only 450, we have to provide additional irrecoverable debt of the difference 90. The second one, return inwards journal, had been completely omitted, so we will just record that this on the credit side 1390, and the rest two will not be recorded here at all in the control account. So 25310 total, balance carried down 23830, and then calculate the correct total of balances in the sales ledger. Let's do this. So balance as per sales ledger currently 23,980. Okay, the first one we will have to deduct it, irrecoverable debt, because earlier it was understated in the ledger. And error number 3, customer's account is understated, so customer's balance understated, so we will have to add it now 120. And the fourth one, the sales returns should have been posted to the credit side of customer's account, but it is posted to the debit side of customer's account, so we will have to reduce it twice from the customer's account. So credit note incorrectly posted, $180. So 23,830. Balance as per control account. Since these two values are the same, you can be mostly assured that the answer is correct. Control accounts do not reveal every type of error. State 3 types of error which are not revealed by control accounts. So any 3 types of two-sided errors you can state here: error of commission, omission, error of principal, error of original entry, complete reversal. Anything is okay. Question number 4. G Limited manufactures products at 2 factories. Company uses marginal costing. State 4 assumptions used in marginal costing. So what are your assumptions? See, when you prepare the marginal costing profit statement and then you calculate the break-even point, what are the elements that you use in the formula? Fixed cost upon contribution per unit, which is selling price minus variable cost per unit. So what is our assumption? Our assumption is that all these 3 elements are constant, because if anything changes, break-even point changes. So we can state that fixed cost will remain same or will remain unchanged. Selling price per unit will not change. And variable cost per unit will not change. So these three assumptions are simple. The fourth assumption, what you can say is that all output produced is assumed to be sold. Basically, you assume that you will not have any inventory, or there will be no difference between opening and closing inventory, because that's the assumption of this formula. Because the cost is related to production and selling price is related to sales. If you produce using this formula but you're not able to sell it, how will you recover your profit? So these four assumptions are simple to understand and learn. State the formula for calculating the margin of safety in units and sales value. So margin of safety is simple: actual output minus break-even output. And sales value is simple: margin of safety output multiplied by selling price per unit. Simple. At one factory, a single product is made. Following budgeted details are available. Direct material cost 3 kg into $5 per kg, so that makes it $15 per unit. Labor 2 hours into $9.5 per hour, so that makes it $19 per unit. Fixed cost per month is given, selling price per unit is given, and sales is given. Calculate the monthly margin of safety. For margin of safety, first we need to calculate the break-even point. Fixed cost upon selling price minus variable cost. So 66,000 divided by $48 minus total of 15 and 19, 34. So 66,000 divided by $14, 4714.28, and we will round it off to 4715 units. So margin of safety is equal to actual output 8,000 minus 4715 units, so 3,285 units. Okay. The directors are concerned that there could be a fall in demand for this product. They plan to make some changes to reduce the product's break-even point and encourage sales. Use a different grade of material. The list price of this material is 10% less per kg. Earlier, the list price was $5 per kg. So if we reduce 10%, it becomes $4.5 per kg. Each unit will require 5% more kgs. Earlier, the requirement was 3 kgs per unit. Now, if we add on 5%, so we get 3.15 kgs per unit. The supplier of the material have agreed to give a 20% rate discount. So on this 4.5, when we apply 20% rate discount, we'll have to multiply this by 80%. So final rate will be $3.6 and 3.15 kgs will be the consumption. Make alterations to machinery to improve the efficiency at a cost of 24,000. Depreciation is 25%. So annual cost of machine will be 25,000 into 25%, which is 6,000. But we're talking about monthly data here. So monthly will be $500. 6,000 divided by 12. Sales commission of $0.5 per unit. So this reduces the net selling price and also reduce the selling price by 1.5%. Currently the selling price was $48. If we reduce 1.5% from it, and from that we'll have to subtract $0.5 for the commission. So that works out to $46.78, the net selling price or the revised selling price. Calculate the decrease in monthly break even if these changes are made. So first we will have to calculate the break even. For that we need the revised fixed cost, we need revised contribution. So let's calculate revised fixed cost. 66,000 existing fixed cost plus the cost of machine 24,000 divided by 20. Since the depreciation rate is 25%, it means 4 years. 4 years means 48 months. 48 months means $500 per month. We've already calculated. So 66,500. Revised selling price per unit already calculated. You could show the same working. 46.78. Revised variable cost per unit. So that will include material and labor. For material, you could show the calculation as $5 into 90% into 80% multiplied by 3 kgs multiplied by 105%. This whole thing is material plus our labor cost was $19 per unit. So we are going to consider, I just add that. So $30.34 per unit. So revised contribution per unit will be 46.78 minus $30.34 $16.44 per unit, and revised break even will be 66,500 divided by $16.44. which is 4045.02. We will round it off and make it 04046 units. So now question is calculate decrease. So the decrease will be the old break-even point, which was 3285. Sorry, 3285 was not the break-even point. 3285 was the margin of safety. Break-even point was 4715 minus 4046. So the difference 669 units. At the other factory, monthly production and sales are normally 14,000 units of a different product. This product has a variable cost of $65 and contribution $17 per unit. Budgeted factory cost per month is 128,000. Major customer normally purchases 5,500 units per month. However, the company is informed that no units would be required from August. Directors have two options. First, to reduce the production by 4,000 units and run an additional advertising campaign to sell whatever is the extra. So 14,000 minus 4,000. Basically in option A, they're going to produce 10,000 units and all of this can be sold if they run an advertising campaign of $2,200. Option B, continue with production of 14,000 units and store 5,500 units in a warehouse. So okay, the units the customer does not buy, that will be stored in a warehouse at a cost of $6,000, and at the end of the month overseas customer will purchase all the units at a price of $70. Transport cost will be $1.8 Okay, so how much will be the contribution for this will have to be calculated separately. We'll do it when we do the answer. Option A. Okay, question is calculate the profit for August. So under option A, the contribution is going to be output multiplied by contribution per unit. So 10,000 into dollars, $170,000 is going to be contribution. Fixed cost is going to be $128,000, which is existing, plus additional 2,200 for the advertising. So 130, 200. So that gives us a profit of $39,800. Option B. Here contribution has to be calculated separately for the normal orders and for the special customer because selling price is different. Okay, so contribution from normal orders. $14,000 minus 5,500, so 8,500 units into $17. $144,500. And contribution from overseas customer, $5,500 units multiplied by $70 is the selling price minus $1.8 is the cost of selling, transport cost, and variable cost given is $65. So $3.2 per unit contribution into 5,500, 17,600. And fixed cost will be the existing 128,000 plus rent of 6,000, 134,000. So profit $144,500 plus 17,600 minus 134,000. Basically the two contributions minus the fixed cost. So 28,100. Part F, advise the directors which option they should choose, justify by financial and non-financial. So firstly, financially we'll have to say that option A is better because there the profit is 39,800. So option A because of higher profit. Then non-financial, what aspects can you cover? See, the moment you start supplying to some customer at a lower selling price than your usual selling price, problems might arise with your existing customers. So existing customers should not be aware of this special order. So that is one thing that we can write. Existing customers should not be aware of the special order. Then you could also say that the overseas customer should not resell the products to the business's customers, to own customers at lower than normal selling price. Otherwise, it will be the same thing. The customers would come to know that the business is offering lower selling prices to other customers, and it will be bad for the reputation. And then what else reason can we give? For option A, we can also consider the effectiveness of the advertising campaign can be discussed. Because it may not be successful, and even if you choose option A and if advertisement is not successful, the profit that you aim to achieve or aim to earn may not be earned. So what would be your advice? I think we can give an advice that option B is better, but the only thing that has to be taken care of is that the customer is completely different, or the customer is not able, the existing customers are not able to or are not aware of the deal with the overseas customer. That has to be kept in mind. That's what the advice you can write. Or you could also say that option A is better if you want to write that advice, and just say that since profit is higher with option A, it is better to go for option A. So you have that approach also. You've discussed the non-financial factors. At the end, you can give your judgment based on the financial factor. That's also fine. In both cases, you will be marked. So this completes the paper number 23 also. Hope you are finding this useful, and if yes, please like the video. Please subscribe to the channel. If there's anything, you can feel free to comment below. I will try to reply as soon as possible. Thank you for being there.